Hi everyone, Mike Flores here, co-founder of Trade Prosper, and welcome to video 2 of section 4, using price and moving averages to profit. Now in the previous video, we showed you the long term using the 200-day simple moving average. Now up on the screen, we have the medium term using the 50-day simple moving average. So what I have up on the screen is a chart of GLD, which is the ETF for gold. If you want to know more about what ETFs are, check out our website, www.tradeprosper.com, and go to the free modules section, and we have free modules on more about the markets. Anyway, so looking at GLD, we can see here that we have green and red bars, which are the price action, and then we have this blue dotted line, which is the 50-day simple moving average. So the difference between using the 50-day simple moving average and the 200-day simple moving average would be that you'll get more signals with the 50-day simple moving average due to the shorter time frame. So what you'll notice is that the line is closer to the price action. So which means you'll catch the move earlier and you'll also exit the move earlier. Now, during periods that the market is just going sideways and it's not moving in a clear direction, you'll also have more false breakouts. So those are some of the advantages and disadvantages of using the 50-day simple moving average over the 200-day simple moving average. But let's take a look on the chart here. So I'm not going to go into full detail about the stop losses. We did that in the other video. You can review that there. So we'll just walk through this example. We see here the first day that price closes below the 200-day simple moving average happens on this day, October 23rd, 2012. So on that day, you would get short, and your stop would either be the high of the day, the line, or you would use a previous resistance level up here. So now you're short, and you can see here that if you use this high, then 2 days later you were stopped out. If you use the line, then you were stopped out over here. And if you use previous resistance up here, you weren't stopped out. So again, you got short on this day and you really ride this, you get stopped out here. You would get short again on this day or this day because it closed right below it. And then you'd really be short for a really long time and capture really nice profit in this market. Now let's move along in the market and see what happens. So you see here on this day, you would have been stopped out, right? You cross back above the blue line, the 50-day moving average, and you get stopped out, and now you get long. The next day you would have been stopped out again, and now you go short. Now notice how the market's moving a bit sideways to small down here, so you're seeing more whipsaws or false breakouts of the line. One way to combat this is by using options. I only use the 50-day moving average with price with options for the most part because I like to avoid these whipsaws. I have a good friend who doesn't mind the whipsaws and he prefers to trade the line without options. So it's really up to you. You have two options to use this technique with. But let's move along and see. Notice here you would have had to deal with the line and the whipsaws here. Here you'd have had a clear direction. Here you go with whipsaws again, whipsaws again. Here goes some whipsaws. You would have caught this little move up, got stopped out here, made some money on that move. Would have been whipsawed a little bit here. Long there, out there. Short here. And you'd still be short this market after this move down. You'd either be short here and stopped out here if it closed above the line, which it didn't. The line is 120.09. It closed at 120.02. So you'd still be short here, and you'd be short the GLD or the gold market at the end currently today. So this is a really good technique that I wanted to show you, and I showed you the pros and the cons of using it versus the 200-day simple moving average. Remember, you can use options, and Billy Fillion, my colleague, will show you that in a later date and time in another section of this course. Alright, so that's the power of using the 50-day simple moving average to catch the medium term trends. See you guys in the next video. Bye now.